Hello everyone, welcome to the weekly lecture videos. This is the last video this week, and in this video we are talking about alternative issue methods with a particular emphasis on initial public offering. When a company decides to issue a new security, it can sell it as a public issue or a private issue. Okay. In the case of a public issue, the firm is required to register with the country's Securities and Exchange Commission. Okay. However, for example, in Australia, if the issue is to be restricted to fewer than 20 investors, or the amount being sought is less than 2 million, the sale can be carried out private. In this case, a prospectus is not required. So you may remember we discussed about prospectus in the previous video. A private placement is an exclusive offer a firm makes to a select group of investors to buy securities in the firm. Okay. These investors are usually institutions such as managed funds and superannuation funds, and they are willing to support the issue. When a firm first seeks equity capital, it is referred as initial public offering. And when it is subsequently returns to the market to raise further equity capital, it is by way of a right issue or a private placement. Okay. To formally define, initial public offering is where a firm issues securities to the general public for the first time at the time of going public. Okay. The offer is open for a time, usually 6 to 8 weeks. And at the close of the offer, shares are allocated to investors on a discretionary basis. It could be that all applicants are allocated a number of shares, and then investors who wish to buy more are allocated a percentage of the number sold. Obviously, all initial public offerings are cash offers. If the firm's existing shareholders wanted to buy the share, the firm would not need to undertake a public offering in the first place. And the second type of issue is called right issue or a private placement, okay, also called seasoned equity offerings in the United States. In a right issue, the firm offers existing shareholders the opportunity to buy additional shares in the company. The right issue is a new share for a company that has already issued securities, that already has securities traded in the market. A rights offering of ordinary shares is made to the existing shareholders of the firm on a proportional basis to their existing shareholding. If the rights issue is renounceable, then the existing shareholders have the option to sell their entitlement. Okay, so this table shows total equity raised in Australia for the period from 25 to 2015. You can see that the initial public offering increased from 14.9 billion to 38.9 billion over this 10-year period. Okay. And you can see the similar trends for the private placements and as well as the right issue. So now let's talk about underwriters. Underwriters are usually involved when a public issue is made for cash. The lead managers or corporate advisors manage the issue of securities on behalf of the issuing firm, performing a range of services, including formulating the method used to issue the securities and marketing the issue, pricing the new securities, and selling the new securities. And typically, underwriter agrees to buy all unsold securities at the closing date of the issue and accepts the risk of not being able to sell all the securities to the public. This ensures the issuing firm is guaranteed receipt of the full amount they are seeking from the IPO. The underwriter charges a fee for bearing this risk, and the amount is a percentage of the funds to be raised. The fee the underwriter charges will be based on the underwriter's assessment of the risk of not being able to sell all the shares to the public. Underwriters may combine to form an underwriting group called syndicate, right? To assist in marketing the issue and to share the risk of any market shortfall. In a syndicate, one of the underwriters will become the lead or principal manager of the issue and arrange the offering. The lead manager typically has the responsibility of pricing the securities. The other underwriters in the syndicate serve primarily to distribute the issue and are sometimes referred to as sub-underwriter. Okay. So as I already mentioned, that the services are the formula for the method formulation, pricing the securities, and selling the securities. Now we will talk about types of underwriting, and first of all, the standby underwriting. With the standby underwriting, the issue is guaranteed. The issuer is guaranteed that the issue will be fully subscribed because the underwriter agrees to buy any shares unsold as at the closing date. And this is the most common type of underwriting in Australia and most other countries. If the underwriter has to buy unsold securities at the close of the offer, it will be required to hold these securities for a specified period of time before trying to sell them. In standby underwriting, the issuer receives the agreed upon amount and all the risk associated with selling the issue is transferred to the underwriter. Because the offering price is usually not set until the underwriter has investigated how receptive the market is to the issue, this risk is usually minimum. Okay. This also means that the issuer does not know precisely what its net proceeds will be until the offer price is established. Next is best effort underwriting. In best effort underwriting, the underwriter is legally bound to use their best efforts to sell the securities at the agreed upon offering price. Beyond this, the underwriter does not guarantee any particular amount of money to the issuer. And this form of underwriting has been very uncommon, and nowadays it's almost rare. So standby underwriting is the dominant form that we discussed in the previous slide. The next is Dutch auction underwriting. With Dutch auction underwriting, the underwriter does not set a fixed price for the shares to be sold. Instead, the underwriter conducts an auction in which investors bid for shares. The offer price is determined based on the submitted bids. A Dutch auction is also known by the more descriptive name uniform price auction. This approach to selling securities to the public is relatively new in the IPO market and has not been widely used there, but it is very common in the bond markets. Okay. Let's talk a little about the underwriting fees. Employing an underwriter is not a trivial exercise and is costly to the issuing firm. Okay. In recent years, 2016, the fee in Australia averaged from 2.5% to 8% of the amount of funds to be raised. The underwriter will advise on price and take into account the likely reaction of the market to the issue, which would include an assessment of the issue's brand name awareness, the position of the firm in the industry in which it operates, and earning growth. The underwriter will also take into consideration the amount of funds to be raised, the number of shares to be sold to the public, and the amount retained by the current owners. Now let's talk about IPOs and underpricing. Determining the correct offering price is the most difficult thing an underwriter must do for an initial public offering. The issuing firm faces a potential cost if the offering price is set too high or too low. If the issue is priced too high, it may be unsuccessful and have to be withdrawn. If the issue price is below the true market value, the issuer's existing shareholders will experience an opportunity loss when they sell their shares for less than they are worth. Okay, so underpricing is fairly common. It obviously helps new shareholders earn a higher return on the shares they buy. However, existing shareholders of the issuer firm are not helped by underpricing. To them, it is an indirect cost of issuing new securities. Now the question is, why does underpricing exist? So, based on the prior evidence from the market, that underpricing is very common, one can ask a question that why does underpricing exist, right? Look, there are various explanations, but to date is a lack of complete agreement among researchers as to which is correct. Okay, so let's discuss some of the arguments or some of the explanation of underpricing puzzle. Okay, first, the average figures that we look at of the underpricing is apparently attributable to a smaller and more highly speculative issues. So that means if the firms are relatively smaller and highly speculative, these firms are relatively young. So investing in these young firms may be very risky. Okay, arguably they must be significantly underpriced on an average just to attract investors. Okay, so this is one explanation of the underpricing phenomena. Okay, I repeat that underpricing is commonly observed among the securities issued by firms. Those are young, relatively young, smaller, and those are relatively speculative, more speculative, because they are more risky investments, so they must be underpriced. The second caveat is that the relatively few IPO buyers will actually get the initial high average returns observed in IPOs, and many will actually lose money. Okay, so although it is true that on average IPOs have positive initial return, a significant fraction of them subsequently experience large price drops. Furthermore, when the issue price is set too low, the issue is often oversubscribed. This means investors will not be able to buy all of the shares they want, and the underwriters will determine the allocation of shares among subscribers. The average investor will find it difficult to obtain shares in a successful offering because there will not be enough share to go around. On the other hand, an investor blindly submitting orders for IPOs tend to be allocated more shares because issues go down in practice. Okay. Okay. Now let's talk a little about the private placement. I mean, the broad heading is new equity sales and the value of the firm. Look, once a firm has made an initial issue of shares and is listed on the stock exchange, it can obtain additional equity funds by making a rights issue or a private placement. Private placement becomes a more favored form of new equity raising in recent years. A private placement is an offer made to a select group of investors, usually institutions such as managed funds and superannuation funds, who are willing to support the issue. These investors may or may not be current shareholders of the firm, and the offer is not extended to all shareholders. A private placement is not normally underwritten, but the firm may use the services of a stockbroker or investment bank to select the institutions to which the private placement will be offered. In a private placement, there are greater certainty in pricing, and the offer is finalized in a few weeks' time. As this is an offer to buy new shares in the firm, the price will be less than the current market price. But if it is set too low, it will cause a fall in the overall share price of the firm, and so would not be in the best interest of the existing shareholders. And the alternative to a private placement is rights offering, which we already have discussed, is an offering by a firm to existing shareholder on a proportional basis, okay? Proportional basis to their current shareholdings. And it seems a reasonable presumption that new long-term financing is arranged by firms in order to finance net present value projects. As a consequence, one might imagine that a firm's value should go up upon the announcement that is going to raise additional finance externally. Okay. Now, look, a number of researchers have studied this issue. Okay. The issue means that share price tend to decline following the announcement of a new equity issue, although they tend not to change much following a debt announcement. Okay. That means when a company announces to issue new equity, the share price typically declines, but the announcement of debt does not. And there are some explanation for that. For example, first of all, is signaling and managerial information, signaling and debt usage and issue costs. Let me very briefly talk about this. First of all is managerial information. If management has superior information about the market value of the firm, and it may know when the firm is overvalued, if it does, it will attempt to issue new shares when the market value exceeds the correct value. These will benefit existing shareholders because the potential new shareholders are not stupid, and they will anticipate this superior information and discount it to lower market prices at the new issue date. Debt usage. A company is issuing new equity may reveal that the company has too much debt or too little liquidity. One version of this argument says the equity issue is a bad signal to the market. After all, if the new projects are favorable ones, why should the firm let new shareholders in on them? Okay, so it could just issue debt and let the existing shareholders enjoy all the gain. Okay. Issue cost, we also discussed that there are substantial costs associated with selling securities. Okay. The drop in value of existing shares following the announcement of new share is an example of an indirect cost of selling securities. And this drop might typically be in the order of 1% to 3% for an industrial corporation. Or so for a large company, it can represent a substantial amount of money. Okay, we label this drop the abnormal return in our discussion about the cost of new issues later. Okay, now cost of issuing securities. Issuing securities to the public is not free, and cost of different methods are important determinants of which is used. These costs associated with floating a new issue are generally called flotation cost. Okay, so let's take a more closer look of those costs. So there are the 5 categories of cost: the underwriting fee, other direct expense, indirect expense, abnormal returns that we just discussed in the previous slide, and underpricing. Okay. And you can see that all these costs are briefly explained here. Underwriting fee, or we also discussed that underwriter charges fee for taking the risk of selling the securities in the market. Other indirect costs are, for example, filing fees, legal fees, taxes. Those are associated with issuing shares. Indirect expense are not reported in the prospectus, and they are typically the management time spent working on new issue. We discuss abnormal returns. In a new issue of shares, the price of existing share drops on average by 1% to 3% upon the announcement of the issue, and this drop is called abnormal return. And we also discuss underpricing, that initial public offering typically are underpriced to attract new investors. Okay, so let's talk about issuing long-term debt. The general procedures followed in a public issue of debt, which can be bonds, debentures, or unsecured notes, are the same as those for shares. The issue must be registered with ASIC. There must be a prospectus and so on. However, one difference relates to the registration statement. In the case of a public debt issue, it must include a trust deed. Okay, you might remember we learned about trust deed earlier. Another important difference is that a large majority of debt is issued privately. There are 2 basic ways of privately issuing long-term debt financing: term loans and private placements. Okay, so term loans are direct business loans. These loans generally have maturities between 1 and 5 years, and most term loans are repayable during the life of the loan. The lenders include financial institutions such as banks, insurance companies, and other lenders that specialize in corporate finance. Debt private placements are very similar to term loans, except that maturity tends to be longer. Okay. The important differences between direct private long-term debt financing and public issue of debts are described in these 2 slides. So a direct long-term loan avoids the cost of ASIC registration. That means if you're borrowing from a bank directly, this loan doesn't need to be registered with ASIC. Direct placement is likely to have a more restrictive covenants. It is easier to renegotiate a term loan or a private placement in the event of a default. It is harder to renegotiate a public issue because hundreds of holders are usually involved. That means if you have issued bonds, there are hundreds and thousands of geographically dispersed bondholders, so it will be very difficult to renegotiate. Life insurance companies and superannuation funds dominate the private placement segment of debt market. Banks are significant participants in the term loan market. The cost of distributing bonds or debentures are lower in the private markets. Okay. The interest rates on term loans and private placements are often higher than those on an equivalent public issue. This difference may reflect the trade-off between a higher interest rate and more flexible arrangements in the event of financial distress, as well as the lower cost associated with private placement. In addition, public issues are usually listed on the stock exchange, and this marketability contributes to lower interest rate. An additional but very important consideration is that the flotation cost associated with selling debt are much less than the cost associated with selling equity. So this is essentially the end of our video and end of our discussion on different issue approaches. So if you have any question, any problem understanding any of the topic that have been discussed in the videos this week, just let me know. Okay, thank you very much.